Welcome back to Talk Tickers. Today, we're doing a deep dive into AEye's second quarter 2025 earnings call. That's ticker LIDR.
That's right. And management, specifically CEO Matt Fisch and CFO Conor Tierney, they didn't hold back. They called Q2 a significant inflection point for the company.
An inflection point. Okay, that's a strong statement. We need to unpack why they think that, especially given how the market reacted, which was, well, a bit wild.
Yeah, definitely a roller coaster reaction. It really highlights the story here. Modest current financials, but a management narrative absolutely brimming with commercial progress and strategic momentum. They're signaling a shift.
Okay, let's set the stage quickly then with those Q2 numbers. What did they report?
So GAAP EPS was negative 18 cents. The non-GAAP figure came in at negative 35 cents.
Right. And just for everyone listening, GAAP is the standard accounting, while non-GAAP often pulls out certain items to give maybe a clearer view of core operations as management sees it anyway.
Exactly. Helps cut through some noise potentially. Revenue, though, was still quite small, about $202 million for the quarter.
$200,000, basically. And that led to a gross loss.
It did, about $0.09 million gross loss. But importantly, they finished the quarter with $19.2 million in cash, equivalents, and marketable securities.
Okay, so they have some cash. And what about the burn rate? That's always critical for these companies.
That was actually a positive data point, relatively speaking. The quarterly cash burn, if you exclude financing activities, decreased, came down to $7.1 million.
Okay, lower burn is good. But you mentioned the market reaction was a roller coaster.
Oh, absolutely. After the call, the stock surged in after-hours trading. Clear initial excitement about the updates. Yeah. But then the next morning, a pretty sharp reversal. Sold off significantly. It just screams divided investor sentiment, lots of volatility.
That classic tension, right, between the promise, the pipeline they're talking about, and the current, actual dollars and cents. Yeah. Investors want proof.
Precisely. Which brings us to management's narrative about that inflection point. They're saying Q2 marked a real shift towards commercialization, towards sustained revenue.
And what evidence did they offer for that?
Well, they highlighted a much bigger sales funnel, over 100 active prospects now, they said. And get this, 30 of those are apparently in advanced negotiations.
Okay, funnel growth is one thing. Did they close any deals?
They did. They actually tripled their number of revenue-generating contracts during the quarter. Went from 2 up to 6.
2 to 6. Okay, that's tangible movement. Small numbers still, but the right direction.
It is. And beyond those specific contracts, they mentioned having clear visibility now to thousands of non-automotive unit orders down the line.
Non-automotive, interesting. But what about the big fish, the automotive OEMs?
Ah, yes. Headline grabber, really. Their Apollo LiDAR system was selected by a, quote, leading global transportation OEM.
A big one, okay. For what?
For a critical autonomous safety program. This isn't just a small pilot. They're talking about a potential $30 million multi-year opportunity.
$30 million. Wow. When would revenue start?
Expected to kick off in 2025, so relatively soon, and span over 2 to 3 years. And crucially, AEye people are apparently already on site with this OEM, working on integration and deployment.
Boots on the ground. That sounds serious, yeah. Much more than just a paper agreement.
Exactly. It signals real commitment. Real progress. And that wasn't all on the OEM front.
Oh, what else?
They also mentioned making significant progress separately with a top 5 global OEM in the passenger vehicle space.
A top 5 car maker. Is that linked to their Nvidia certification? That seems like a big deal lately for LiDAR companies.
It seems very much connected. Apollo is now fully certified as an Nvidia DRIVE AGX partner. It's integrated into the DRIVE AGX Orin platform.
Okay, technical terms there. But what does that really mean for AI in the market? Why is that Nvidia stamp so important?
It's massive. Think of it as a shortcut, a credibility boost. For an automotive OEM looking at AV systems, choosing suppliers is a huge, risky decision.
Right. Multi-year commitments, safety, critical systems.
Exactly. So Nvidia coming in and saying, look, AEye's Apollo is pre-validated, it's integrated with our platform, that drastically lowers the perceived risk for the OEM. It de-risks the integration.
So it speeds up the sales cycle.
Hugely. And it doesn't just stop there. It plugs AEye into NVIDIA's whole ecosystem. Yeah. That includes potentially getting onto their Hyperion full-stack ADS platform.
Which gives them much wider reach.
Transformative reach. Potentially.
Yeah.
NVIDIA isn't just certifying them. They're providing sales, marketing, business development, deployment support, the whole package, both for automotive and these non-automotive physical AI markets they're targeting.
That level of partnership support sounds like a game changer for a smaller company like I.
It really could be. It extends their credibility and reach far beyond what they could manage alone.
And speaking of pushing boundaries, there was another interesting partnership.
What was that?
I was picked as the LiDAR partner for something called Wintour. It's a project sponsored by GM, actually, and led by the University of Toronto.
Mentor sounds cold. What's the focus? Exactly. Autonomous driving in really tough weather. Heavy rain, snow, conditions where sensors often struggle.
Ah, so proving their tech works in the worst conditions.
Right. And the strategic angle is that this positions AEye to actually influence future OEM specs for ADS systems.
Yeah.
If they can prove reliable performance in snow, that becomes a benchmark. It's a long-term play.
Okay, interesting. Now let's shift gears a bit. They launched something called OPTIS. You mentioned physical AI earlier. What is OPTIS and why this push outside of automotive?
Right. OPTIS is key to understanding their diversification strategy. It's built on Nvidia's Jetson Orin platform, by the way.
Okay.
And it's not just a LiDAR sensor. It's what they're calling a physical AI stack. Basically, it combines their sensing with intelligence right on the device edge analytics.
So the processing happens right there, not sent back to the cloud.
Exactly. It delivers an integrated, turnkey solution for specific jobs. Think airport safety, monitoring secure perimeters, logistics optimization, applications where you need real-time understanding of the physical environment. That's the physical AI part. AI interacting directly with the real world via sensors.
So instead of just selling the sensor hardware, they're selling the whole smart system built around it.
Precisely. And the move into these non-automotive areas, smart infrastructure, industrial, is super strategic.
Why? Faster money.
Essentially, yes. Automotive cycles are incredibly long. Years, sometimes a decade, from winning a design competition to seeing meaningful revenue. These other markets often move much faster.
Quicker adoption, clearer unit economics, maybe?
Exactly. It lets AEye generate revenue sooner, prove out their tech in real-world deployments, gain market traction, and frankly, learn things that feed back into their automotive efforts.
Makes sense. And OPTIS itself uses an open architecture.
Yeah, and a third-party developer network. That's designed for scaling efficiently. It really marks this shift they're making from being just a sensor company to being a platform plus applications vendor.
Okay, so that's the strategy. But what about the core tech, Apollo itself? I always emphasizes its technical advantages, especially the 1550 nanometer wavelength. Can you break that down? Why does 1550 nanometer matter?
Absolutely. So most LiDAR systems out there use 905 nanometers. The key difference with 1550 is eye safety.
Eye safety.
Yeah, 1550 nanometer light is much less likely to harm the human eye. That means AEye can pump out significantly more laser power compared to 905 systems.
And more power means?
Longer range and higher resolution. They talk about unmatched 1-kilometer detection range with high resolution. For high-speed driving, seeing small obstacles far away, that extended range is absolutely critical.
A kilometer? That's impressive. What about the software-defined part?
That's another really key piece, especially for cost. Instead of designing and building different hardware versions for, say, highway driving versus city driving.
Which would be expensive.
Very expensive. Apollo's behavior can be changed significantly just through software updates. They can adapt it to different use cases, optimize performance for specific conditions, all without a costly hardware redesign. It makes their development cycle much more capital efficient.
That capital efficiency must be a major focus.
It has to be. And technically, there are other points. They use a bistatic design.
Bistatic.
Yeah, separate transmit and receive optics. Think of it like having separate eyes for sending out the light and seeing what comes back. Instead of using one shared path, it improves precision, especially in tricky conditions.
Okay. Anything else unique?
Well, for defense uses, their scanning method is interesting. It's randomized, not like a predictable spinning mirror. That makes it much harder to detect or jam. More stealthy, you could say.
Ah, a potential advantage in that sector.
Definitely. And it can also be mounted behind the windshield, which is important for aesthetics and integration in passenger cars. No ugly spinning turret on the roof.
Right. Okay, let's pivot to the financials again. They talk about a capital light strategy. What does that mean in practice? Are they like a fabless chip company designing but not manufacturing?
That's a really good analogy, actually. They aren't trying to build giant LiDAR factories. Their focus is on the core tech, the IP, the design.
So they partner for manufacturing.
Exactly. They mentioned partnering with Lighten, for example, for production scaling. The goal is to keep their own cost structure lean, avoid heavy investments in fixed assets, and pour that capital into R&D and commercialization instead.
Smart. Did that strategy show up in the numbers this quarter?
Well, despite some one-time costs like a $1.4 million lease settlement, which actually avoided a much bigger potential $6.4 million liability down the road, their overall cash burn still decreased, as we mentioned. That points to discipline.
And the operating expenses?
GAAP OPEX was $8.6 million. Non-GAAP OPEX was lower at $6.8 million. And net cash used in operations also decreased quarter over quarter. So signs of tightening the belt.
Okay, but the really big financial news seemed to happen after the quarter ended, right? Regarding their liquidity.
Absolutely critical point. Since June 30th, they've significantly boosted their cash position. More than tripled it, actually.
Tripled it? How?
Through financing activities, likely utilizing their available facilities. This extends their cash runway significantly, now projected out into 2027.
Into 2027, that's a lot more breathing room. What's the total potential liquidity look like now?
When you combine their cash on hand with their equity line of credit, the ELOC, and their at-the-market or ATM facility, the total potential liquidity stands around $126 million.
Okay, explain ELOC and ATM quickly.
Sure. An ELOC is basically an agreement, usually with an investor, allowing the company to draw down capital by selling shares over time, as needed. An ATM lets them sell new shares directly into the open market, again, over time, usually more gradually. Both provide flexibility to raise cash without a big single offering.
So $126 million potential pool of funds gives them a much stronger footing to execute their plan.
Definitely. Though, it's worth noting, they did update their full year 2025 cash burn guidance slightly upwards to the high end of the $27–29 million range.
Why the increase?
They cited that lease settlement, some convertible note payments, professional fees, and ongoing product development investments. But importantly, they do expect cash burn to be lower sequentially in the second half of the year.
Okay, so near-term bump, but trending down hopefully later in the year.
Yeah.
How does all this fit into the broader LiDAR market context?
Well, you see a trend where peers are really prioritizing getting those big OEM design wins, sometimes even overshowing immediate revenue.
Yeah.
And having that Nvidia integration is becoming almost table stakes for serious players in ADS and AV.
A validation hurdle they need to clear.
Exactly. Investors seem to reward companies with credible OEM pipelines, even if sales are still small today.
So AEye securing that big OEM deal and the Nvidia certification fits right into what the market wants to see.
And their shift with OPTIS, moving beyond just sensors to platforms and applications targeting non-automotive, how does that play? I think it's seen as a smart strategic move. Trying to build more diverse, potentially faster-moving revenue streams to complement the long automotive cycles. It addresses that gap.
But the market reaction was still mixed, you said. That sharp sell-off after the initial pop.
Yeah, it really underscores the skepticism. The market sees the potential in the pipeline, the partnerships, but it's still questioning, okay, when does this translate into real, repeatable revenue and profits? Timing and conversion risk are clearly top of mind.
Yet, despite that skepticism, how has the stock actually performed recently?
Interestingly, despite the short-term volatility and the losses, AEye stock has actually significantly outperformed the broader QQQ Tech benchmark over the last 3 months, and even the last 12 months.
Really? So beneath the surface noise, there's maybe a cautiously bullish, longer-term sentiment building.
It suggests that, yes, investors might be willing to look past the current numbers if they believe in the long-term story and see these key catalysts lining up.
Okay, so what are those key catalysts we should be watching for, say, over the next 6 to 12 months? Second half of 25, first half of 26.
Number one, absolutely, is concrete news on that $30 million OEM program, formal contract signing, initial revenue recognition. Any hard proof points there will be huge.
Makes sense. What else?
More news on OPTIS deployments. Actual unit orders shipping in those non-automotive areas like smart infrastructure, security, logistics. That shows the diversification strategy is working.
And Nvidia.
Any further integration or new wins specifically tied to Nvidia's Hyperion platform would be a major validator. Also, keep an eye on industry events, JP Morgan Auto Conference, KPMG Automotive Innovation Summit, IT World Congress. News often breaks there.
Got it. So ultimately, it boils down to execution, right? Converting that pipeline they talk about into actual shipments, revenue, and showing a path to making money long term.
That's the core challenge. That's the true inflection point the market is waiting to see validated by results, not just commentary.
All right, let's move to our segment. This is not financial advice. We look at potential market narratives or trade ideas floating around purely for informational context, of course.
Of course, not advice.
Given everything we've discussed about the OEM win, Nvidia, the cash raise, but also the skepticism, one interesting, let's call it aggressive, hypothesis we've seen discussed revolves around a kind of synthetic long LiDAR spread.
Okay, sounds complex. Break that down. What's the thinking?
The core idea, the hypothesis, is that if AEye does deliver on crystallizing that $30 million OEM deal and gets deeper into Nvidia's Hyperion ecosystem, its stock could get significantly re-rated upwards.
Okay, so a bullish bet on AEye delivering. How is it a spread? Well, to manage the volatility and address that market skepticism we talked about, the hypothetical trade pairs a long position on AEye, maybe using out-of-the-money call options to get leverage with a short position.
Shorting what?
Shorting a carefully selected basket of other LiDAR companies, specifically peers that are perhaps seen as less differentiated, still burning lots of cash, and crucially, haven't secured those key Nvidia tie-ins or haven't successfully diversified into faster markets like AEye is trying to do with OPTIS.
I see. So it's not just a bet on AEye, but a bet against certain competitors, a bet on divergence.
Exactly. It's a bet that the gap between the potential LiDAR winners and losers is going to widen significantly. The rationale leverages AEye's recent capital raise, giving them runway, and their expected decrease in cash burn later this year as potential catalysts for them to outperform these specific peers.
So if AEye's inflection point narrative actually plays out, this kind of spread strategy could, hypothetically, generate outsized returns by playing that relative performance.
That's the theory behind it.
Yeah.
A bold bet that AEye is truly pulling ahead of a certain segment of the pack. Again, purely hypothetical market thinking.
Understood. Okay, let's wrap up this deep dive. To recap, AEye's Q2 2025 call presented a company very much asserting it's at a turning point.
Yeah, marked by that major OEM win, the critical Nvidia integration solidifying, and the strategic launch of OPTIS to chase non-automotive markets. It paints a cautiously bullish picture, at least from management's perspective.
But challenges remain. Financial runway looks much better now, extending into 2027, which is huge, but cash burn is still significant, and the market needs to see that pipeline convert into real, repeatable revenue.
Absolutely. Management's focus is clearly on execution now, converting those wins and demonstrating the diversified strategy can deliver.
And just to reiterate, everything discussed here is for informational purposes only. It is definitely not financial advice. Please always do your own thorough research and consider consulting with a qualified financial professional before making any investment decisions.
Well said. And maybe a final thought for you listening. What's your take on AEye's physical AI and diversification strategy? Do you think moving into non-automotive is the key differentiator for survival and success in this really competitive LiDAR landscape? Something to think about.